radio for a really great future. We're talking real money.
It's radio. It's a podcast. It's everything. It's talking real money. Hello, I'm Don McDonald along with Tom Cock. And you are invited to join us here on the program with your questions about money, your thoughts about money. You just call us at 855-935-TALK, 855-935-8255. If you've listened to us for a while, you're probably aware of the fact that we're not big fans of what this stuff called private equity. Well, our buddy Jason Zweig at the Wall Street Journal did a great article recently on private equity, basically saying things like investors are paying between 5 and 12% to get into private equity. Oh, then you have to give up like 20% of what you make. Even worse. Some cases the markups are 43% in one case. Another deal he found, it charged you $2 to get into an investment that was immediately worth $1. What? I mean, this is ridiculous. This is stupid. And yet money is pouring into them. And in some cases, it's money that you are going to be relying on, particularly those of you in the great state of Washington.
Yeah, Washington is should be in the national headlines for this story, but I will give credit where credit is due, because the Seattle Times, which is from time to time does a little investigative work. This is really a good piece. And if you have not read it, if you're not a regular Seattle Times reader, you should figure out how to get your hands on this, because the headline says it all, but it's pretty interesting where it goes from the headline. It says, Washington Treasurer warns state to pull back on private equity investments.
Wasn't that what I was just talking about?
Yeah, well, you were talking about how expensive it is to buy them. Well, and by the way, you were kind, because there's other ones where it costs 25% even for them to let you in the club.
Well, yeah, and I didn't even get into the opacity of these things. the fact that when you own them, they tell you they're worth X, but they could be worth B. Not even Y, B.
For full disclosure, Don and I have been in private equity investment. We're still in one.
Well, it's our own company, though.
I know, but it's private it's stock.
Yeah, but we didn't go out and seek some bigger than life investment.
We're not only investors, we're operators.
Right,
we're there every day.
Different.
We're running.
That's any small business in America.
Yeah. But I was thinking back to another one I owned.
Yeah. Is this the farmland?
I've had some.
No.
No, this is one. The radio business I was in, that didn't work. I was in another investment management company. That did work. I went back and looked it up once. It made like 30% a year. And then I got my money at the end. So sometimes it works and sometimes it doesn't.
But the problem, though, is for a pension plan. I mean, this is a retirement plan.
Yeah.
How can you know at any given moment what that portion of the portfolio is worth? If you have stocks, well, there's a market value of those that's established every second of every business day. But that's not the case with private equity. Yeah, with bonds.
And here's the reason we're concerned about this. Here are the numbers you should pay attention to. 28% of the Washington State Pension Fund is invested in private equity. And by the way, when you add real estate to that...
Oh, that doesn't even include real estate?
No. That's far more than what they own in publicly traded stocks. So in other words, illiquid, I think what you just said is very important.
Real estate's illiquid, yeah.
Exactly. And you don't really know what it's worth until you get your money back. And for them in this article, by the way, they claimed, Alyson Tucker, who is the CEO for the Washington State Investment Board, claims that private equity has returned 12.3% a year over the past 20 years, which would be astounding, by the way. It's a great return. I'm not quite sure how you can say that unless you've gotten all the return from those investments.
Well, what percentage in total is in real estate and private equity?
They give it to us here in actual numbers. So out of $185 billion, there's
$185 billion in private equity. How much?
No, 185 is the total pension fund.
Oh, that's the total pension.
Yeah. And then 52 of that's in private equity, and 33 billion of it is in real estate. So there you go. Wow,
so 84. That's over half.
Over half.
That's over half.
By the way, it's more than any other pension plan in the great United States of America, period.
I mean, let's say that worst case scenario, we don't really know what they're worth, but I mean, it's conceivable that portion of the portfolio in a market downturn could easily and quickly be worth 50% of whatever it is they're quoting.
Well, and it's happened to them before, by the way, in 2007 or 8, I think it was, where one of the funds went bust and they took a big loss.
Yeah, so that would bring the total in the pension fund down to about 140 some odd $billion, which looks to me like a pretty big hit to those.
What is a big hit? And the thing is, as you know, demographically, it's still about half the people that are adding money to this and half that are taking money out. The legislature has been, guess what? They've been adding less because they don't have to, because we've been making so much money on the fund. Again, taking additional risk of things not being fully funded.
Well, this is a public pension, though. Who is in charge of making this decision?
Washington State Investment Board. It's a board, and there's a person who runs it. I used to interview that person every year when I had the television show here in Seattle. Every year.
Who is that person again?
No, it's a different person than it is today.
Oh, different person.
Now it's.
I'd just like to know how qualified these people are to make these decisions.
We'll get into that in just a moment if you really want to know.
I really want to know. An inquiring mind really wants to know. And darn it, it sounds like something that folks who are participating in the pension plan might want to get upset about.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
855-935-TALK is our phone number if you have a question about your money. Your pension, if you're in Washington State, apparently, if you're receiving a pension or hope to be receiving a pension from the state of Washington, you probably should be more than a little concerned. Because
I think if a third of the money is in private equity, that's an outrage.
And a lot is in real estate, far more in real estate than we would suggest any portfolio own. And the reason I'm concerned is because I would imagine, I know they have a board and it's very political, the investment board. I'm sure it's a bunch of political appointees and, union members and things like that. But usually these boards have a group of experts in investing. And I'd like to know how they arrived at these decisions. What is it in their background that made them overweight private equity to such a ridiculous degree?
And to the highest degree of any state in the country. That's something else to consider. That Allison Tucker is the CEO.
Yeah,
she's the one who gave us the quote about the return. No, she's a staffer. She's not the political person. That would be the chair.
Okay.
Who is a woman named Yona Makowski.
Yeah.
The chair. And by the way, Yona's background, from what we were able to discern, started
political.
in biology.
Oh, biology. That's right. Her undergrad was biology. I looked her up.
And then we're not making any, mine was in history, so I
have absolutely no experience in this. It's not about what they did in college. It's what I'm wondering is, and I just did a little looking during the break. They have a group of people who are their non-voting investment experts. And I went through at least the few backgrounds I could find, the resumes of some of these people, and one of them is a venture capitalist. That's her real life job,
which is a similar industry to what we're talking about here.
Yes.
Yeah,
of
course.
And another one is part of a family office for rich people, which means they're always going for those special investments that rich people are supposed to have.
Yeah, okay, so let's go back to why this number one, it concerns me because of lack of liquidity. Number two is it concerns me because of it's greater risk. It has to be greater risk than public markets because public markets have liquidity. Every day could get the money, which does bring me to number three. Right now, I think I read that $7 billion went out last year in payouts. That number is going to increase. Basically, it has to because the demographics. There's going to be fewer and fewer people putting money into this and more taking it out. So that's nerve-wracking. And here's the part that concerns me a bit more when the chair, Yona Makowski, says the proposal takes some steps. We're talking about a proposal with the board to lower risk, but cautioned against rapid shifts in strategy. Here's the quote. We cannot just dispossess of some of these assets overnight, she said.
Overnight? You can't even get rid of them in the next month, I'd be willing to bet.
Or longer. I mean, it depends on what you're in and and that is the exact problem with holding these, frankly, in anything, but especially in a public pension plan where you may need more money, where if the legislature continues to underfund it, et cetera, it could be a real problem. Let's just put it that way. So it's troublesome. I mean, they quote a number of experts in here saying the same thing.
Well, okay, now you said
risky.
Their return has been what?
Well, no, the return on the private equity
on the private equity has
greatest.
been. That's the part. What's that been?
12.3.
Okay, 12.3.
Yep.
But that's what
20 years.
What is that number based on?
That they don't give any specifics there.
Well,
That's
I
what
know
was
with private equity, I know what it's based on. It's based on whatever the private equity firm says their internal analysis says it's worth.
Yeah.
Which
you don't know that, by the way, till you get the money back.
Which
ever
have we ever known people in the investment industry to lie about the value of the portfolio?
You've seen this happen with public.
Madoff.
We've seen this happen with public companies, not just private ones. This actually happened with public ones. So, and so the 12.3, by the way, I went back and looked at the last 20 years. If you're in an all-equity global portfolio, you made quite a bit less than that. It was a little over 10%. So you made 2% more being in private equity, which is what you should anticipate for the risk.
You apparently.
That's true. You don't know that. That's a good point.
It appears you made 2% more. It appeared that Bernie Madoff's investors made,
that's a good point.
15% per year, whatever the number was. It appeared that way, but it wasn't really the case. With public markets, you have a really good idea of the true market value of the portfolio. You can never have that with private equity by definition. And I'm sorry, the state of Washington, the House of Representatives and the Senate and the governor and whomever else is involved in this is acting horrifically irresponsibly and should stop it immediately. And I'm telling you, if you're part of if you're part of this pension plan, you should be up in arms.
Put your hand up, call your representative, do something, because this is problematic. And beyond what they're saying, well, we'll look at it. Yeah. They really should try to decrease this in a fairly rapid fashion.
They should eliminate it.
They'll never do that because they held the stuff. I remember when I covered it, as I said, 25 years ago, and they told me, we have a little bit of that, just for a little taste of what could be greater return.
Well, wait a minute. Didn't one of the really big pensions decide to go totally public?
I believe that's one of the states back east. Yes, they're all they have one person working there, and they're an index fund. So it's not the industry that all the rest of these are, for sure.
I just find this abhorrent, and the thing that shocks me is that Washington is generally a very intelligent state. It is known for its high degree of intelligence, sensibility, and to have basically the worst pension plan in America in terms of private equity, should be embarrassing.
Yeah, I think they're going to tell you they have the best because the return has been so good.
Yeah, well, just wait for a meltdown. Just wait. We don't know when the bad times are going to happen, but we know they're going to happen, and when they happen, the public investments will fare probably much better than will the private ones because you can't unload them in a bad market.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Doing my typical break research, and I've noticed a trend in pension plans.
Yeah.
You folks on the West Coast think you're smarter than everybody else.
Didn't you just say that 5 minutes ago? You just said we're very bright people
Washington's has 28% in private equity.
Not including the real estate.
Right. No, just private.
Yeah.
Oregon, they're trying to catch up. They're really working.
Just like everything else they're doing. I get it.
They're so close. They're at 25.6% in private equity.
With a bullet, probably. Yeah, okay.
Now, CalPERS is below. They're only at 18%, but in terms of dollars, they're bigger than either of you.
They're huge. Yeah.
And then it starts to plunge in the other states that think they're better than everybody else. I'm going to give you another example. Massachusetts, they think they're smarter than everybody else. They're at 16.5 approximately.
We got a message from Massachusetts. We're not only smarter, but our football team's much better than yours, too, just so you want to know.
Texas, and they think they're better.
They're bigger.
They're bigger. They're better. They're Texas. They're at 14% private equity. New York, they think they're smarter. 14. And Florida? Florida.
Yeah, right. Yeah.
11.
Yeah, okay. Well, you're looking brighter every day. And by the way, I think in this article, and again, praise to the Seattle Times. This is a lengthy piece. A lot of work went into it. States are, guess what? Most states are trying to sell off. They're trying to reduce their exposure. Most.
And now would seem to be the time to do it.
One might imagine.
I don't time the market, but right now things are good. They might be better. They might be worse. I don't know. But when they're good and you're overweighted in a certain asset class, isn't that when you rebalance? Mm-hmm. Yeah. See, it strikes me that maybe they've been letting their private equity run, and it's become, I don't know what the history is, but maybe it's become a larger and larger.
It's probably like that, yeah.
Yeah, because we don't want to sell
no
anything.
Intention. Yeah, I wouldn't want to make something sell go away.
I'm sorry, I'm this is a guess on my part, but I think one of the reasons they may not want to sell right now is because it'll show that the emperor's clothes have fallen off. It won't look as good as they think.
Yeah. Okay.
Anyway,
well, when you actually get the payout, you mean actually get the money?
No, right. If you sell it, and they're going to go, oh, really?
And we need to remind people again, when they say the return has been X, nobody really knows. And if you say you have $50 billion in private equity, nobody really knows. You don't know that until you get the cash in hand.
Then it's like your house.
Yeah. Exactly.
I think my house is worth $1 million. Well, no one's willing to pay it, but I think it's worth that when, in fact, it's worth $600,000. 855-935-TALK is our phone number. Let's head to Kirkland, Washington. And Luke, welcome to Talking Real Money.
Hi, Tom and Don.
Hey, Luke.
Just full disclosure, my wife and we're appellate clients, and I'm a retired teacher drawing from the state pension fund, and I read that article with interest in the Seattle Times also. I know the Washington State Investment Board has had amazing returns, and you can designate, and I also had defined contribution money that you can designate how much you can have them in control of. I have a little bit, but it is interesting.
It scares me.
It's fascinating. Yeah, I think, again, for me, it's the things I just mentioned, but also the fact that are we taking risk we don't need to take? In other words, they're very proud of the fact that they've done better, may have done better. And when I look at it, I think, did you need to do that? Is that a risk you needed to take? I'm not so sure.
Well, let's say their 12% is actually 20% inflated. Right. Then their returns look like the market.
Exactly. It doesn't take that much of a change to look like publicly traded stocks.
Right. Anyway, what else is on your mind, Luke?
I have a question. Okay, First of all, if someone's at home thinking about where they can get retirement information, I would urge them March 7th, RetireMeet. Like you said, one day, all these experts, Christine Benz, wrote the book, How to Retire, 20 Lessons for a Happy, Successful, and Wealthy Retirement.
Tom, did you pay him to do this?
And
the check's in the mail, Luke. Don't worry. So you got that covered.
I've been to every RetireMeet, and I'll be in the front row again with my wife. But
that's so nice.
My question, I've been listening to Warren Buffett on YouTube, and Charlie Munger is no longer with us, but Warren Buffett says in retirement, your two goals should be simplification and preservation. I wonder if you both can expand and elaborate on that.
We absolutely will, but it's the bottom of the hour, and in radio, that usually means news, of course, and commercials because they pay the bills. So we will elaborate on those ideas in just a bit.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Yes, indeed we are, and we're talking about every aspect of your financial life if you choose to do so by calling us at 855-935-TALK, 855-935-8255. So Luke asked us to elaborate on Warren Buffett's retirement advice that your two primary goals in retirement should simply be to simplify and protect your assets.
Oh, okay. I couldn't remember the second one. I mean, getting old and getting close to retirement. I write them down.
It's pretty simple.
Yeah.
Simple, and protection.
I guess the second one, the latter. When you say protection, what does that mean exactly? Does that mean, bury it all in the backyard? Does that mean I'll put it in a bank somewhere? I mean, hard to say what that means exactly.
Is what you're saying.
Right. It's not easy to say.
But I think though that our philosophy fits in with that. In essence,
no
in retirement, do not take more risk than you need to take.
Yeah, and
that's protection.
And one of the things I'll be talking about at RetireMeet, by the way, which is I just looked it up today, is 2/3 sold. 2/3.
2/3.
So if you want to join us,
wow.
Yeah, you want to join us, you better get on it. But I think that's a reasonable strategy. The former, simplify, again, somewhat complicated, but if you're going to manage your own money, I think a very few accounts and a very few funds in those accounts.
But simplification can also be, like Luke said, he was a client of Appella.
Yeah.
It can be hiring an advisor because that simplifies your life, and you put the onus now on a professional. As long as you can find those rare professionals who are always required to act as a fiduciary, and as you know from listening, there are, I believe, and the numbers, by the way, the studies bear this out, so it's not just a belief, but you have to be careful what you say, so I'm going to be careful. I believe that the majority of people who offer financial services are not always required to take the best care of you.
Well, it's way beyond just the majority.
It's 99%. 99-1.
Yeah, so it's
according to
unless
market
that's really
watch.
Changed. I mean, that's
maybe
a pretty big swap.
It could be changing.
Well, it is. Because guess what? The insurance companies now want to. Didn't I just read State Farm is starting an RIA? I mean, all these people they want to be in the business because they want to be able to say that. Look, we're not selling anything. We're acting in your best interest. So anyway, but
like the
those
recent
are two good
podcast
things.
where we talked about that guy who was kicked out by FINRA and then got his insurance. He had his insurance license and then got an RIA so that he could say he was a fiduciary.
Yeah, it's very tricky.
You should listen to those
I
podcasts,
like those two.
Folks. Podcasts are important.
Podcasts, yes. So in addition to this program, we do Dawn. In fact, I haven't listened to Fridays because something happened yesterday. I wasn't in the car for Friday afternoon.
You did not
I got it.
hear
I've saved
Friday's
it.
podcast with
I
the
will
grandkids?
No, I didn't have them yesterday till the party last night. We had a
I worked
pate.
so hard on that one.
Yeah, I know, but I will listen. It's still
Actually,
loaded.
I didn't. It was only a 4-questioner, so it was short.
Oh, kind of light. So, but simplify, protection, sure. I think those are reasonable things to aspire to.
And we really don't need to elaborate much on those because we truly believe that. Simplify your portfolio,
right.
Protect your capital. Let's go to Indianapolis. That's in Indiana, where it's probably a lot colder than it is here. Jane, welcome to Talking Real Money.
Hi, Tom and Don. Thanks for taking my call. I have a quick question. For an actively managed portfolio, is a fee of 1.25% with a maximum fee of 2.95%, is that outrageous?
Yes.
Or is that pretty much standard?
I'm going to vote out. I'm voting outrageous right off the bat.
Make sure I understand what you're saying, because you started out with 1.2, which would not be outrageous, but then you it's higher than I'd like to see you pay by 20%, sure. But then you said you ramped it all the way up to 2.9?
2.95. 2.95.
Yes, it says the net maximum fee at 2.95.
Okay, so what that means
crazy.
is that the 2.95 applies to smaller accounts, maybe under 100,000, maybe under 500,000, but then small accounts are going to get the 2.95. The 1.25 is going to be when you get into the millions of dollars under assets under management, sorry.
Which we are not. We are about $800K.
You're going to pay my guess, you're going to pay in that 2% range.
Yeah. Which is too high. I also am a little concerned, Jane. Yeah, that's 100% more at 2% than I would recommend. So that's a lot. My other worry is when you say actively managed portfolio, does that suggest that they're buying and selling things? Does that they know the future? Or does that mean somebody just has their hand on the tiller and is sort of paying attention to things? Which do you believe the actively managed describes?
That is a good question.
Let me ask you a question.
I don't know the answer to that.
Why are you looking at this firm?
Well, we actually are currently with this firm, and we also met with the advisor last month, and she told us that we would only be able to meet with her 2 times a year because she's so busy.
Oh, that's nice. Can you do me, maybe you can, hopefully you can do this from memory. I hope. Do you remember the names of any of the investments that you have with this advisor? The
mutual funds or exchange traded funds or the underlying assets that you hold.
Yeah. Remember any names?
Well, currently, or the one that she is proposing that we go
let's
to.
do the proposing. That's more fun. Let's do proposing.
There, Christmas comes early for Dawn on this one. Yeah, that's for sure.
Okay, so she is proposing 9 funds in large cap U.S. blend equity.
Do you remember the brand of the funds?
The name of the family.
The name of the firm?
The name of the actual mutual fund company.
The company that is
gotcha.
American funds, Fidelity funds, Vanguard funds, Dimensional fund. Pardon me?
They are a mix.
Yeah.
There's a mix. There is a CGGR.
CGGR, okay.
Mm-hmm.
What else do you have?
HCMIX.
HCMIX. Okay. CGGR. Let me just look those 2 up.
CGGR is Capital Group, so yeah.
Okay, yeah, we're getting a really good idea. Let me do just a little bit of additional research, and we're going to hold you over this break, please, and we will talk more on the other side. You're going to want to hear this.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
And we're talking with Jane in Indianapolis at 855-935-TALK, 855-935-8255. And Jane, I have a really short question for you.
Yes.
How much do you like having the living daylight scared out of you by your portfolio?
I would prefer a stable portfolio.
Would you? Okay. Well,
without a lot of surprises.
I don't even have to look at any of the other funds after looking at HCM Tactical Plus Fund Class I shares, which is what she's suggesting. Yes. That's the HCMIX. I'm going to watch Tom's expression here. Ready?
Because I didn't look it up.
Here's the expense ratio, Tom.
No.
1.73%.
A thing to remember about that, Jane.
That's
you're
on
right.
top of your fee.
That's what I'm saying. So let's say you're paying 2, then you're paying that on top of it. So now you're paying almost 4%.
4%.
Yeah, I mean that's
okay.
really outrageous.
Annual turnover.
Well, no, what? How much?
264%.
So that's the number. So if you start the year and then you buy, sell, you've turned it over 200 and some %, which is outrageous.
How many stocks
truly.
In the portfolio?
I'm going to guess and say 49.
On the large cap?
18. 18 stocks. And the stocks in the portfolio are NVIDIA, Meta, AMD, Alphabet, Amazon, Microsoft, Apple, Qualcomm, Amgen.
And you could go buy that in the QQQ for about 1/100th of that. It's something crazy like that.
Standard deviation is a measure of volatility, how risky a fund is. The 3-year standard deviation for a very aggressive fund for us is the Avantis Global Equity Market. We think is a very aggressive fund. And the standard deviation for that is 12% a year.
I was going to say 16. Okay.
The standard deviation for the fund you're looking at is almost 19.
Yeah, so half again as much. This is just, again, but you said at the beginning, actively managed. So the fund is actively managed. And then I worry the advisor is actively managing as well. That's why maybe she's proposing you these new funds. This is going to be better, et cetera, et cetera. So this is 180 degrees from what we believe about globally diversified portfolio, low cost, low turnover, and therefore hopefully lower volatility. I mean, because that fund has the opportunity to be kind of all over the map, I'd say.
Geez, this thing. This is a the advisor portfolio for me.
Okay.
Yeah. Anyway,
and then if she 6 years ago sold us a zone variable annuity, is that another indicator of the?
Yeah, it doesn't surprise me.
Advisor?
I like her less all the time, and I didn't like her.
She's consistent, though. We'll give her that.
Yeah, she's consistent in trying to make money for herself and
herself.
Yeah,
that's
variable annuities, pretty ancient product, one that we don't favor either.
Okay.
Now, what was the name of the
I
variable annuity again?
appreciate-
Because that name didn't ring a bell with me. Zone?
It's a zone variable annuity,
ZONE.
ZONE.
Oh,
Yeah, I don't
Zone
know that.
Choice. Zone Choice. For a true stage zone choice. Okay.
Yes.
Yeah.
Yes.
I'm going to let me look up the fees on that one. But wow, this is not a fiduciary in my book.
No, they can't be if they're selling you a variable annuity. And frankly, to use those funds, I don't know how you could call yourself a fiduciary because you're supposed to be putting your clients' interests ahead of your own. And you could be buying those same basic portfolio for far, I can't say enough fars less.
Okay.
Yeah.
Don's
so
looking into the
appreciate
zoning out portfolio.
And here's how I
not
know
good
that.
advice.
Here's how I'm pretty confident she got a commission off of that, which would make her a non-fiduciary. The surrender charge on that was 8% for the first 3 years.
Which is what she earned in selling you into the
Probably
annuity.
that's the commission she received.
Okay.
So you
Thank
got
you for
you
your
got to
guidance
find
and your information.
You've got to find a new advisor. You really do. This portfolio. If you called and you had this portfolio, we would tell you that this was a horrible, dangerous, high risk, scary as all get out portfolio.
High expense.
High expense, high risk.
Yeah.
Oh, not good.
Okay.
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 Sorry
I
the news
appreciate your information.
isn't better.
So
Thank
glad you
Jane.
called, really, Jane. Thank you so much because once you get changed, you're going to be so much happier.
Yeah, that's and let's just leave it at that. I think it's enough said. So
Yeah.
wow.
Thanks so much. 855-935-TALK is our phone number. That's 855-935-8255.
It's one of the worst we've heard in a while. I'll put it that way.
It really is. I have to say
Fairly
that.
egregious.
This advisor, I mean, let's start. Let's just recap. Let's start with a maximum fee of 2.95. That's one of the highest investment advisory fees I have ever seen. Ed Jones has taken theirs down to 1 point something. You know, most of the major firms have gone way down. That is at the highest end. And the reality is, unless you get into probably 8 figures, you're not likely to get to that lowest fee. I don't know the company, so I can't tell you for sure. But with that big a spread, they're not going to save their low fee for anyone but their biggest clients.
Big.
So my guess, she's in the 2% range. Then you add in these incredibly expensive funds. 1.73.
Very few stocks, by the way.
Wow.
Yeah, okay. And somebody just
sad.
texted me and said you really scared her. That's not our intention to scare you, but our intention is to be honest with you about the portfolio.
Did she say she was scared, or somebody else?
No, somebody else was listening. Just texted me.
I'm sorry, but
really
I guess the intent was to try to scare a little because
to fix it.
We all, as investors, need to hold our advisors to a high standard and really hold their feet to the fire and make them either get rid of them or make them behave in your best interest. This advisor is not. This advisor is acting in her best interest, whether she knows it or not, and she should know it.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And by the way, I'd rather scare somebody with my thoughts and ideas than have them scared when they lose 50% of their assets.
Which in those portfolios, I mean, certainly with that concentration, that cost of turnover, all that kind of thing could really happen pretty easily. So and by the way, there have been people who have called us about their portfolios and we said, that's really good.
Yeah.
So it's not always just, fire the person, get on with it.
I think in 2022, and I don't still have the fund up on my screen, but I think in 2022, that fund lost about 35%.
It would not surprise me. I mean, with that, again, concentration risk, et cetera, et cetera. So, yeah, we've got lots of questions. So, or you can call us, 855-935-TALK, or you can write us. You go to talkingrealmoney.com and click on Contact Us, and you write a question like Jim from Los Angeles, California wrote, "Hi, Don and Tom. I love your podcast and listen nearly every day. I talked to a guy in Houston yesterday, and thank you for listening. You know who you are. He said in the last 2 weeks he listened to the last 3 years of podcasts.
That's so.
Of which I suggested I wouldn't even do to my ex-wife.
Apparently, he didn't sleep.
Apparently not.
Here's
my question:
breathe and sleep, talking real money.
Is there any drawback to converting my Vanguard mutual funds to their equivalent ETFs? I know I can do this without triggering a taxable event, but once I do, there's no going back. Before I pull the lever, I thought I'd get your take on this. Mutual funds to ETFs.
I can't think of any drawback. No.
No.
I really can't think of any.
Especially if it's a taxable account, because there you're going to be getting the advantage of some tax.
But
even if not breaks, but it would be better for taxation.
Even if not, generally ETFs have slightly, and with Vanguard, we're really talking slightly lower.
Not much.
Yeah,
not a lot. But they're going to get that
downside.
Preferred tax treatment. You can trade them always for free, no matter what custodian you're with. So they're pretty strong.
Yeah, that's another advantage that we don't talk about very often is the ability. If you, like today, you want your money faster, you don't have to wait an extra 24 hours. Right. Owning a mutual fund means you add an extra day before you can get your money, so it's a little bit faster to get your money from an ETF. A little bit. And
I think still with some custodians, if you have somebody else's funds at that custodian, you could pay a charge to buy or sell.
Look at you with another advantage. Because because you
Finally
don't
remembered something.
ETFs are just they trade like stocks. Right. But if
Yep.
you have a Vanguard fund, you want to buy a Vanguard fund at Schwab, they're going to charge you $79, I believe.
Which is just absolute insanity in today's world. Makes
when you
no
can
sense.
buy the same thing in an ETF for $0.
Yeah. It's ETFs are coming for you if you're a mutual fund, so pay attention.
It's all over. They won.
Yeah, I think they did.
They
but
won.
We'll see.
I'm telling you, everything eventually is going to convert. I mean, okay, not everything. There are still closed-end funds out there from the 20s.
Well, that's true. Or will everything be tokenized instead? And remember, that takes on a different meaning than it did for me in college, but that's a whole other topic.
That was a real stretch. And hopefully, and I know
One tokenized
many of you won't even get it until he did that. Go to Talking Real Money.
This hour is up in smoke. Can I just say that? Sorry.
You only have 25 seconds left. Go to TalkingRealMoney.com to ask your questions. Go to TalkingRealMoney.com to meet with one of our advisors for free for nothing with no obligation. And also go to RetireMeet really quickly, RetireMeet.com, because apparently, RetireMeet only has about a third of its seats left, which sounds like it's going to sell out in a couple of weeks. Go to RetireMeet.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.